Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. So welcome to 2014, and Chris and I thought we'd kick it off this week with a discussion around some of the investment themes that we see for 2014. Just real quick, Chris, when we look at 2013, you know, the U.S. equity market's very strong, and we did see that the global economy, generally speaking, put some traction into slow growth. So why don't we start with the growth theme first of all?
Sure. Well, if we look at the global economy, we expect that growth to continue, and we could see even in some areas such as the U.S., maybe even some modest acceleration. We've seen a little bit of evidence of that in the U.K. When we look at monetary policy, we expect that to remain accommodative. In other words, interest rates likely to remain low throughout the balance of this year and probably into next. And Canada could actually benefit from a recovery that we're seeing take hold in Europe and in China.
Yeah, right. So in Canada, for instance, when they talked through most of 2013 about the potential for a housing bubble, I think the prognosticators are off that because it's more of a soft landing is what really occurred there. And so following that up, probably going to see a softer Canadian dollar due to the accommodative stance of the Bank of Canada, getting even more dovish. Now the wild card, as you say, Chris, is the Euro-China thing. If that really gets some traction, that'll benefit Canada, but probably going to be more modest than anything else.
That's right, and that benefit comes more on the commodity side of things. So if we look at the 2014 investment strategy, we would continue to favor equities over bonds. We've seen yields drop to the lowest level in 30 years and likely to remain relatively low. So equities probably offer more potential growth. And in the U.S., Grant, we had a very strong year, as you pointed out last year. This year, probably likely more moderate returns.
Right. So last year, was a culmination of two important things: the growth in the economy getting a little bit of traction, and earnings improving, and that allowed things to sort of normalize or catch up to where they needed to be. Now in the U.S., it's probably going to be more about pure profit growth because we're accepting the fact that the U.S. economy is on better footing now. You know, in Europe, when we look at it, it's probably where the U.S. was 2.5 years ago, and that's why a lot of people are suggesting that maybe Europe is the next place to be, in terms of allocating some capital in portfolios.
Now, one thing that we saw last year take place was when the Federal Reserve in the U.S. announced that they were going to start to taper their bond purchases. Most defensive sectors, interest sensitive, sold off significantly. We saw that moderate as we went through the latter part of the year, and actually into this year we've seen some recovery in some of those sectors.
Yeah, so looking for, on the equity side, looking to certain sectors for outperformance, and that would be financials, technology, certainly the industrials, Chris, and perhaps the healthcare sector as well.
That's right. If we look at bonds, as we said, there's probably better opportunities in equities, but you still want to maintain some fixed income. Just want to maybe look to move up the credit quality scale there. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to take a look at Q4 earnings, which are about to kick off here in a week or so. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.